Live from New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, rock-solid jobs growth in America, driving bond yields much higher and leaving the door wide open for more hikes. We begin with the big issue, one number on everyone's mind.
75 is the new 50.
They're going to go to 75.
Definitely 75, I think, is in the cards.
It's going to be 75 basis points.
This is the perfect opportunity for the Fed to be able to deliver that 75 basis point rate hike.
The lack of payroll slowing.
A very strong payroll print.
This gives them the opening to do that.
This Fed isn't stopping.
You have an overheating economy.
Then I'm taking the under on the 4%.
They probably get to 3 to 3.25% in a rush.
The data is going to corroborate that they're going to slow down.
The data is going to start decelerating pretty quickly.
They're going to go to 75. I do think they're going to go 50, but then I think this thing they're going to have to slow down.
Joining us now to wrap up the week and break down a payrolls report is Kroll's Megan Greene, MUFG's George Goncalves and Zach Griffiths of Wells Fargo. Megan, first to you, how bright is the green light for a 75 basis point hike this month?
Yeah, I think it's looking pretty good, actually. I mean, this jobs report, it was hard to thread the needle on this and get a Goldilocks jobs report, but we managed to because it was incredibly strong in terms of the number of jobs that we've added. So suggests that we're not actually in recession or even really slowing as quickly as many feared. But actually, wage growth came off pretty significantly. So we had wage growth of 0.3% month on month. That's way off of where it was even just in May. And so that suggests that the economy is still strong. It also takes some of the heat off of inflation, but it gives the Fed some room to hike aggressively. So I expect the Fed will hike by 75 basis points again, and then I think they'll start to slow down. So another 50 basis points and then 25 basis points into the end of the year. But for this next one, I think 75 basis points is almost assured.
Zach, is that your view as well?
I agree with 75 at the July meeting. I think they'll drop to 50 from there, but I think there's several 50 basis point rate hikes after that, and the Fed will eventually have to take the policy rate something like 4.25% to 4.5%. And it really comes down to the inflation situation. We saw some encouraging numbers with the average hourly earnings coming down a bit, but I still think 0.3% month over month is too high for the Fed. They have a tough job to do, and they're going to have to go pretty quickly through the end of the year to combat inflation.
Zach, let's build on that because it's a big call. And you're not alone. I've heard it several times this week. I heard it this morning from Matt Lazzetti of Deutsche Bank. He thinks we need a 4 handle on Fed funds. Why do you think that's what it's going to take? And what's the pushback that you're receiving from clients, and what do you say back to them?
Well, the big question is, where is inflation in 6 months? And we're expecting that PCE, core PCE, on a quarter-over-quarter annualized basis, so really looking through the year-over-year numbers and getting the trend of inflation, is still at 3.5% in the fourth quarter. That's just way too high for the Fed. They don't want inflation expectations to get anchored well above 3%. And so taking it to 4.5% is going to actually start to bring the real Fed funds rate, so taking Fed funds less your favorite inflation measure, into positive territory, which is something they've done in nearly every tightening cycle in the past. So we think that's why they're going to have to take it up above 4%.
Megan, let's get your view on that. There's 2 points there. Ultimately, how sticky do you think inflation's going to be through the end of this year and into next year? And how high will this Fed funds rate need to go?
So I think inflation is going to start coming down by the end of the year. It will be well above the Fed's target, clearly. But I don't actually think that the Fed's going to get to a 4 handle. I think the Fed needs to splice out what inflation is driven by demand and what inflation is driven by supply side factors that the Fed can't do anything about. The San Francisco Fed came out with a paper recently showing that about half of inflation was driven by supply side factors, which the Fed has no tools to address. About a third was by demand side factors, and the rest was sort of undetermined. And so that suggests that actually the Fed doesn't need to get rates up so aggressively to over 4% in order to lean against inflation. So I'm actually a little bit more dovish.
So, Megan, this is a tough question to answer, I know, and you've touched on several aspects of the answer. But ultimately, what is restrictive for the Fed? What do you think the setting ultimately is to get to that restrictive stance?
Well, the Fed estimates that the neutral rate is 2.5%. So above 2.5% is restrictive, and it's absolutely appropriate for the Fed to hike beyond the neutral rate in order to bring inflation down. The balancing act, of course, is just that the Fed wants to bring inflation down without tipping us into recession. And I think that's going to be really difficult for them to do. But I don't think they'll need to get to a four handle in order to lean against inflation. In fact, we're already seeing some of the supply chain side issues start to abate, and I expect that to continue over the rest of the year as China updates its zero COVID policy in particular.
Zach, can I throw the same question at you? Where do you think restrictive is? I know you think we're going to get out to 4, maybe 4.5, but where do you think that restrictive point is for this Fed?
I think you got to get to 3% to really be restrictive, so a little bit higher estimate of the neutral rate than the Fed has. And so we think they can do that over the next couple of meetings. But again, this inflation is sticky. I take the point that at least a portion of it is supply driven, and that's not something that the Fed can affect with its policy rates, but they're in a tough spot, and they've clearly communicated recently that they are willing to take the policy rate in more restrictive territory until they see meaningful realized deceleration in inflation. So their commitment to almost a single mandate at this point is what's a part of our call for a much higher terminal rate.
Exactly. It raises the question. Let's talk about the risks around that view. How bad do you think the data needs to get before they start looking at that and not the inflation prints?
It'd have to be really bad. And it's tough to imagine a set of circumstances or a set of numbers in the near term that get them to really back off in a meaningful way unless inflation comes down much more than we expected. And as I noted, we do have inflation coming down, but at 3.5% on an annualized basis in the fourth quarter of this year, I just don't think that's low enough. I think they'd really like to see a 2 handle, maybe something in the low 3s. They could start to consider meaningful progress. I wouldn't say that's a victory quite yet, but perhaps that's where they start to shift their focus to inflation expectations and can start to massage the message a little bit. But we got a long way to go until we get to that point.
Zach, where have you got GDP forecasts for this country next year, given you think we can get out to 4.5%?
So our full year estimate is 0%. So we do have a couple of quarters of negative growth in Q2 and Q3, so a mild recession. But as we go forward for the rest of this year, we look for positive growth, perhaps a little bit lower than the 2% potential. But that recession that we're calling for is driven by this need to over-tighten, if you will, or bring down inflation in a meaningful way that we think is just going to be very difficult. You're not going to see enough realized progress on the inflation front until, let's say, the first quarter of next year. Perhaps some of these numbers we're talking about drop into the 2 handle range, and then the Fed will be able to reassess. I think the big question next is, are they able to cut rates quickly? Do they have to go below neutral, or is inflation still sticky enough that they just have to bring it back toward neutral and can't even move into accommodative territory in the near term? So that's the thing that we're looking at, how much the market is priced for as far as cuts in 2023, and we think it's a little bit too much.
So, Megan, you've got one side of this debate who look for a Fed rate through 4%, 4.5. You're taking a view that they don't have to go that far. Do you share the recessionary concern at all, or do you think Jim Bullard of the St. Louis Fed is right? We can still engineer what they believe is a soft landing.
I think it's going to be really difficult for the Fed to engineer a soft landing. So I do think that we'll see a recession probably in the second half of next year. Look, we've got 11.25 million unfilled jobs in the U.S., and it would be really weird to have a recession without a significant deterioration of the labor market. And I just don't see that deterioration happening anytime soon. On top of that, there's a massive cash buffer for households in aggregate and also for corporates in the U.S. So we'll need to burn through some of that before we go into a downturn as well. So I actually do agree that the Fed's going to get very restrictive. I just think that that's going to be with a 3 handle, and that will pitch us into a recession. And that recession, I think, should be fairly shallow, could last a pretty long time. I actually think the Fed would feel much better about inflation in the 3 to 4% range. They wouldn't be quite as worried about inflation expectations becoming de-anchored. And don't forget, that's what prompted the Fed to pivot to a 75 basis point hike the last time around. And we had such a big jump in inflation expectations. So, I think inflation of around 3 to 4% with, inflation expectations anchored, there's no real concern about a wage price spiral taking off in that range. I think the Fed would feel much more sanguine around that. They would like to see it come down to 2%, of course, but I think they would stop hiking aggressively if we got inflation in that range.
Zach, I wanted to go to the bond market question off the back of this debate between Meghan and yourself. I assume you think we've got work to do on certain parts of this yield curve, though you did mention the potential for cuts down the road. So what is your suggestion of what people should do at the front end of the curve?
So we still think the front end has to come up a lot, commensurate with our call for a much higher policy rate by the first quarter of next year. If you look at the SOFR futures market, it's pricing in a terminal rate of something like 3.5%. So that's well below what we're calling for. I don't think that's an impossible outcome, but the inflation situation would have to unfold quite a bit differently than we currently expect. So that's the big driver. We think the market is going to have to converge with our view. That's going to take the front end higher. We think the back end of the curve can move higher as well, but not to the same degree. So you get a bear flattening move. And we think by the end of the year, the 2s10s curve will be even more inverted, perhaps 25 basis points inverted. That's our call.
Interesting. Priya Misra of TD earlier on this morning on Bloomberg Surveillance suggesting 2s10s could invert by 50 basis points. Meghan and Zach are going to be sticking with us. If you're wondering where George has got to, we've got to re-establish the connection. A bit of a technical problem. I haven't been ignoring George Goncalves of MUFG, that's for sure. Hopefully, we can do that in a commercial break. Up next, the auction block. Improving risk sentiment, luring issuers back to market very slowly. That conversation up next. I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction block, where we kick things off over in Europe with a host of public sector sales failing to lift weekly issuance. New bond sales slumping below 12 billion euros and falling short of expectations. In the US, high-grade sales rebounding after a week-long hiatus. Kellenys helping break a streak of wide misses, pushing issuance to nearly 14 billion. And the junk bond market lull interrupted by one issuer, Neogen, selling 350 million and breathing life into high yield after the slowest June since 2010. Sticking with credit, BlackRock's Rick Reeder starting to put some cash to work.
The credit markets, we started to let the line out a little bit on some of that cash. You think about if we're going to be run rate inflation over the next 5 to 10 years, you could buy high yield at 9.5. You could buy investment grade quality in the front to the medium part of the yield curve at 5-ish. Boy, that's a pretty good real rate. There's some stuff to do now.
Back with us, Megan Greene and Zach Griffiths. I want to come straight to you, Zach. Rick Reeder there said there's some work to do in high yield, but given that you think rates are going to 4.5%, that we've not seen the high on yields on treasuries, what does it mean for credit spreads on a weaker tightening?
Yeah, it's certainly a difficult backdrop, Jonathan, and so our call is pretty challenging for spreads and for investment grade credit, as that's driven a lot by the move in yield. So I do think that he has a point. We are starting to get to some more attractive levels, but given our view on duration, we would prefer to wait a bit longer and see these yields come back up, see the market converge with our view for where the Fed is going to have to take the terminal rate and then reassess from there. So it's going to be some tough sledding for at least a little bit longer, and we do expect spreads to widen into year-end and into the first quarter of 2023.
Megan, from your perspective, and not as a market participant, as an economist looking at the Federal Reserve, do tightening spreads run counter to what this Fed is trying to achieve?
No, I don't think that I don't think that runs counter to what the Fed is trying to achieve. I don't think the Fed is particularly concerned about where spreads are in any case. They're worried about financial conditions more broadly. So I don't actually think that they're that concerned about tightening spreads.
I'm pleased to say that George Goncalves is going to join us on the phone. I'm just finding that out right now, of MUFG. He's on the phone right now. George, great to have you with us. Our apologies for the technical problem. I'm not sure it's your end or my end, but we can have that conversation now. You missed the conversation earlier. I'm happy to go back to it. Your thoughts on a payrolls report, where you think this Fed is heading?
Fed's still doing 75. They're going to most likely go another round in September, and then I think they'll take a wait and see, because I think by then we'll get more proof that the economy's decelerating.
So they come down to 50, down to 25, and George, ultimately, where do you think they end up?
somewhere in the three. They're shooting for 3+. That's been part of their target for the new updated forecast. But I think that once we get that to those levels, I think at some point there's going to be a U-turn. I think that the forward curve has been suggesting that, and the forward curve is going to be proven right.
So is the 10-year a buy at 3%, George?
I mean, the 10-year is proven now to become a buy between 3 and 3.25, 3.40. If we get back to 3.50, maybe. But I think we're now getting to a point where major dips are definitely a time to start to add the duration.
George, just quickly, looking ahead to next week, what are you looking for in the CPI report?
So I just want to see more on the core side and really get an idea if that is still being sticky. I mean, I think we're all hoping and guessing, and markets are wanting to find proof that the Fed can blink, and there's really no evidence, with today's number on the NFP, broadly strong report, and I think inflation is going to be sticky. I think we have to wait till July and August to really see a turn. And so I think that, I'm still expecting higher inflation reads.
How confident are you that we've seen the peak for headline inflation?
I'm not confident. I still think that there's risk for that we can slip to a little bit higher, and that wouldn't take much. So I think that the base effects will help, but if we and commodities have helped going forward. But I'm not confident that we've seen the peak yet.
Hey George, awesome to catch up. Hopefully we'll get you on camera next time and we can have a longer conversation. George Goncalves there of MUFG. The Federal Reserve has at least got fantastic labour market data, in some parts of it at least, to look at. Europe has a very, very different dilemma. And Megan, I wanted to come to you on that and spend some time on it. We caught up with a couple of people who believe this ECB can only get to zero, then they're going to have to stop. They'll be confronting a recession. It'll be problematic. Steve Major essentially came out and said something similar earlier this week. He's looking for 75 basis points on a 10-year bund now. They get what they call mildly bullish on European bonds like bunds. I'd love your thoughts, Megan, on where you think this ECB is going. And we've talked about how far the Fed can go. How far can they go?
So I can answer that if you tell me what Putin does with gas. If Putin shuts off the gas, they can't get very far at all. And also if you can tell me how this anti-fragmentation tool is going to work, because if it doesn't work, they can't get rates up really at all. There will be an investment strike in Italy, among other countries, maybe Spain. And so I think those are the two key questions we need to know the answer to figure out exactly how high the ECB can get rates. But I would agree, it's not very high, and that might be okay. Look, inflation is entirely different in the Eurozone than it is in the US. It's mostly driven by supply side factors. There are concerns that it will feed through into wage growth later this year in October when we have these major rounds of wage negotiations. But that hasn't happened yet. The ECB is just worried that if they wait until it happens to react, then they're already too late. They're already behind the curve. But it's all to say that, inflation is really supply driven in the Eurozone. Consequently, the ECB can't do a whole lot about it. So I actually think it's fine if the ECB can't get rates up that far. It's not as crucial as it is for the Fed, because in the US, there is a bigger demand component to inflation.
You've touched on the heart of several issues, though, and I think everyone's grappling with them. And Zach, I want your reaction to that. To Megan's point, it's hard to forecast the ECB without understanding what President Putin, the Russian leader, is going to do, without understanding where gas prices will be. And I would say more broadly for the inflation story, and we had the conversation earlier this morning, can you really make a credible call on inflation without really understanding what happens with the world's second largest economy, China, with the stop-start reopening lockdown we've seen over the last 2 years? And Zach, with that in mind, walk me through the range, just how wide the band is around some of your forecasts for this Fed, for 10-year yields and all the rest.
Yeah, Jonathan, there's just so many cross currents and things to consider, especially in Europe with what's going on from a geopolitical perspective. So I think to your original question on the ECB, I think the market is priced for about 150 basis points of rate hikes. That seems like way too much to us. Perhaps they can do 75 to 100, but they have such an uncertain backdrop. And Megan's point that it's really a supply-driven inflation situation complicates things further. So I think the Eurozone economy is very fragile, and it's very subject to what's going to happen with the war in Ukraine. And we really just don't know how that's going to play out. So we have some extremely wide confidence intervals on a lot of these forecasts, especially with what's going on in Europe. And I think when you think about the 10-year yield, bringing it back to the U.S., I think the balance of risks are at least a little bit more balanced than they had been. I still think that you can go quite a bit higher, but there's an argument for the market looking through to a recession in the middle of next year and pulling down their growth and inflation expectations, which is going to have a bigger impact on the back end of the curve than the front end. So that's certainly something that we're considering in a wide range of risk outcomes.
Zach, push that through the FX market. A lot of people have been doing that already. Euro dollar's had a monster year, a bad year. The dollar's rallied the dollar index since the end of Q1 by 9-10 percentage points. Euro dollar today had a break at 101 briefly. Where's this one going? Given everything you've just said, how much downside is there, if there is any, in your mind? Where are we going here?
We see more downside, and a lot of credit to my colleague Eric Nelson, who has been saying that the euro is going through parity. He's been saying it for a couple months now, so we do think it can perhaps even hit a 98 handle, and that could happen in short order. So you have all of these challenges in the Eurozone. You have an ECB that is almost certainly going to hike much less than the Fed. The Fed's already hiked a ton, and the ECB is just getting started. So I think you have a lot of fundamental factors that point to more weakness in the euro, and that's what we're looking for going forward.
Credit to Eric Nelson for making the call. To you, Zach, you're sticking with us alongside Megan. Megan and I have heard that call being made so many times over the last few years, and we got really close today. 1.0072 on euro dollar, the low of the session. Zach and Megan sticking with us. Still ahead, the final spread the week ahead, featuring a host of Fed speak and the latest read on inflation in America. That conversation up next. The volatility in this bond market has been unreal. Yields up by more than 20 basis points at the front end this week. The week before, down 20. It is very hard to keep up. Trying to catch up ahead of next week. Looking ahead to the final spread the week ahead. Coming up, the Fed's Williams, Barkin, Bostic, all on deck with Governor Waller too. CPI on Wednesday, plus PPI and jobless claims coming throughout the week. President Biden heading to the Middle East. And finally, closing out the week with US retail sales. Time for the rapid fire round. 3 quick questions, 3 quick answers. Let's start with this. Have we seen the peak for headline inflation? Yes or no? Megan?
No, I don't think so.
Zach?
No.
Will July be the last 75 basis point hike of this cycle? Yes or no, Zach?
Yes.
Megan?
Yes.
Peak in Fed funds, 2 handle, 3 or 4? We kind of know the answer to this from both of you already. Megan, go on.
Yeah, 3 handle.
Zach?
4 handle.
To the both of you, thank you. To Megan Greene, to Zach Griffiths, and to George Goncalves, who made a brief appearance a little bit earlier on. From me, enjoy your weekend. From New York City, same time, same place next week. This was Bloomberg Real Yield. This is Bloomberg TV.